everybody. Good morning, and welcome back to another Market Movers by Getrich podcast. And today is September 19. So, again, if you're new here, this is where we give you at least weekly updates on what's happening in the global and local markets. So, Edmond, good to see you again.
Well,
Welcome
thanks
back.
for filling in for my absence last week. I
Yeah.
apologize to everyone.
Let's get started. So, what do you have for us, Edmond?
I missed last week, and markets just continue to decline. In fact, I was surprised that we've still seen a drop in the markets. We can talk about that in a bit, both from the holding companies and especially the telcos. And one of the biggest questions that we always get is, pwede na bang bumili? I mean, apart from that, we've seen Fed cuts. We've seen news that Ayala now is expanding its buyback to its other subsidiaries. And even Mega World selling MREIT shares, which caught even me as a surprise given the yields that they were giving. And hopefully it's an excuse because they're doing it so that they can inject more assets into MREIT.
Yeah.
All right, so let's start. We've just seen a sell-off that doesn't continue to stop. There were news that it's been funds heading for the exit, especially from regional. I don't know if this was exacerbated by all the political corruption sentiment that has been happening lately, but the sell-off has been on a nonstop tear. In fact, if you look at valuations, you'll see here average of holding companies now sitting at 6.6 times. I tell people I've never seen valuations this low, but the markets just continue to astonish me and continue to decline. And this is exactly what we're getting. Even in terms of value, market caps, I have not seen holding companies trade at 100 billions in a long time, just to let you know, Paella.
So, does this mean, Edmond, na walang pakialam yung mga foreign's sa valuations natin today?
Yeah, for
They just
sure.
want to get out of the country.
For sure. And, we view it as if it's just a small size of their total portfolio.
Yeah.
And if you get rid of that 0.2, 0.3% exposure in the Philippines so that you won't look stupid to your bosses, then it actually makes sense just to get rid of it and just make back that 0.2, 0.3% in some other market. For a long period of time, you're starting to see more attractive dividend yields. And we always talk about yield. Undeniably, the economy is going through a slowdown, and you'd probably be expecting earnings growth to maybe be less than what the projections are, right? But nonetheless, we really don't know when that thing is going to turn around. And that's the reason why we always talk about yield.
Right.
There's no excuse, right? When you look at 9.2 times PE, you could say that this is 2008, 2009 levels, which I also agree because it feels even worse.
Alam mo, Edmund, when I was looking at it, I think the biggest challenge that we're seeing today, and for me, the reason why Q3 and Q4 is important when it comes to earnings is we just don't see that growth that's happening in the Philippines today. I think, diba, we always tell the Philippine growth story, pero parang, bakit, why is it not reflecting in our companies?
You want to know my honest opinion?
Yeah, go ahead.
I don't think Q3 or Q4 would change investors' minds.
Why is that?
Whether earnings come out positive or negative, I don't think it will change investors' minds. And it's not a bad thing. Sorry, it is a bad thing. But the benefit you can come out of this is that once you anticipate that foreigners will not likely come back anytime soon, if the markets rally, to me, it's always just a buy low, sell high type of environment. Don't expect runaways. I think that's clear.
Right. So it's going to be a range-bound market. That's what we're expecting.
And look at it. You're seeing your sell-off happen in your holding companies, which is great.
Yeah.
Coming to oversold territory. And if you want to be accumulating shares, I won't deny that. But don't expect once these start to rebound that tuloy-tuloy na yan.
Yeah, mag-break out na yan sa mga key levels ng index natin. So I think that's a good emphasis on why we say that we take a look at good quality and then yields. Like it's the same advice, it's the same topic, but I think that's the way on how to navigate the current market that we're in today.
This is telcos, and this is actually my preference because PLDT, Globe, even Converge are being sold off ridiculously. And in fact, you take a look at yield for PLDT, you're actually so close to 9%, Globe 6.5%. And don't forget, these are actually still utility companies, right? And I understand why you're seeing a sell-off included in your telcos, because if you look at ARPUs for all three companies, actually they've been on a decline. And what has average revenue per user. Could be that instead of buying, let's say, for example, 500 pesos on average for prepaid that you spend on every single month, it's been on a decline. And maybe today it's around 485 to 490. But the point being here, I'm not going to figure out why that declined. I'm not going to speculate because it went to online gambling. But I'm just pointing it out that the ARPUs on average have been on decline. The point being here is that people forget these companies are still utility companies. Meaning in difficult times, there's one thing that you don't cut, which is your internet plan and your mobile plan. That one I guarantee. I think at today's yield, even though if you make an assumption that growth is close to flat or slightly negative, think of it this way, that 8 to 9% yield should be more than enough to outweigh that weakness in earnings growth. In fact, if I compare this to the holding companies, I'm actually much more keen on buying the telcos than on the holding companies because of this what I'm showing you on the yields that you're getting from buying PLDT and Globe.
So it's more of like a defensive play at this point when it comes to telcos, positioning yourself in telcos. Yeah,
for sure. I mean, you look at Meralco, you look at other utilities, Manila Water, they've been outperforming because there's less uncertainty coming from the average revenue per user because it's usually guaranteed. Diba? It's not guaranteed for the telcos, but I think you should view it to this extent where it's just too attractive already at these levels. And I'm really excited for all three, actually.
Yeah, just to share how important it is, like yung dividend reinvesting when it comes to these names. So I was doing a deck last weekend, we had a talk, and then I featured Tel. We're not saying that you should buy Tel or Glow or whatever, just a basic fact lang na over the past 5 years, if you've been peso cost averaging in PLDT, peso cost averaging now, whether it's up, down, you're not looking at valuations, on the capital appreciation side, you would have lost money, about like 17-18%. However, if you reinvested those dividends every time that you bought PLDT and every time they paid you dividends, that 17%, that negative 17% is actually positive 3%. So that's how big over the long term, how dividends affect your investment performance. So I think like what Edmund said, but this is an opportunity to take a look at these names and maybe consider it in your portfolios given the dividend yield it's giving.
I agree. And, from a global perspective, this should also be a major reason as to why you want to be invested more into high yield stocks, right? Because interest rates or the cost of debt is now on a decline. Last Wednesday, we've seen first rate cut in a while. Basically, what they've said is two parts. And one of the concerns that we always talk about is inflation going to be sticky? And will they change their framework because of a weak job market, which is exactly what happened. And it's been actually from the Fed perspective, it's actually very mixed. In fact, it is said that this is the most divided we've seen the Fed in a very long time, where 9 out of the 19 Feds still see 2 more rate cuts, and while the 6 see no more rate cuts. And, we only have 2 Fed meetings left for the full year. I cannot blame people because if you look at it from the traditional sense, you'll see here that core inflation has been elevated and still above the 2.9%. If you look at it from this perspective, inflation, this range for everybody to know, was supposed to be sitting at the 2% mark. And we're sitting near 3%. And so the question is, if you're looking at it and you're basing it from this, you'll say, okay, I don't think we can rate cut anymore. Because give or take, you still expect 100 to 150 basis points above core inflation, which is 4.5%, more than actually where we are from today. This is the thing. I think the Fed also doesn't deny that the market is weak. In fact, they emphasize that Gen Z, surprisingly, cannot find a job today. They're really worried about employment. In fact, if you look at housing today in terms of demand is now sitting at 2008, 2009 levels. Even home buyers are actually very weak in this environment. But again, it's tough. You look at one lens and say tariffs are creating inflation, which is it. And then on the other hand, you have a group of people saying, hey, it's just one time. Next year, wala nang tariffs. It's very difficult because then you'll start to see more precise impact on the tariffs 1 year later, not today.
Yes.
And from a Fed perspective, do you do the forward-looking angle or do you stick to data-oriented? And it's a challenge, really. And that's the reason why you're seeing so much mixed feedback on whether they should cut or raise or stay interest rates at these levels. But one thing I do know is that markets will lead. And so markets today are sitting at new high. If you look at interest rates and what the market's already expecting, in fact, they're already expecting 3 more rate cuts in the next 12 months. So if you look at the 2-year interest rates, it's actually at 3.5, 3.6%. So despite the rate cut that has happened, markets are still expecting 2 to 3 more rate cuts in the next 12 to 24 months.
Yeah.
And for me, this is probably just listen to what the markets are saying. And I assume
Yeah.
the reason why they think they will still see more rate cuts, it's because the economy is slowing down, tariffs will likely be transitory, and inflation will start heading downwards thereafter. I think that's
Mm.
what the message the markets are saying. Whether it is right or wrong is a different story. Last two, maybe there's Ayala Corp expanding its buyback to its subsidiaries. I was surprised because then they'll be buying individual companies. For example, like I got the valuations for ASEN, All HC, IMI, and the rest of the other subs. I'll just probably share a story pa na lang.
Sige.
Siguro 14 years ago, I remember Ayala trading from other subs like 2.5 to 3 times price to book. And today, on average, you're probably looking at less than 1 times price to book on Ayala companies today.
Crazy. So what does that mean? What's this? Because we mentioned in price to earnings. So how does price to book relate to the current prices today?
Okay, so think of it from this angle. If you buy
Mhm.
Ayala Corporation, you're buying cheaper than the original investors because price to book is less than 1. So technically, you're buying than the original investors. That's what it means. Ayala has always been given a premium the last 13, 14 years. Today, you're buying cheaper than them.
So
I'm not saying
is it the first time nangyari yan in the markets, or at least in terms of Ayala here in the Philippine market?
well, they've been trading at a discount for quite some time. I think the question being here is, will that change? Okay, so just because you're cheaper than the original investors doesn't mean it's a great buy,
Yeah,
right?
yeah.
It could mean that there could be warning signs or thunderstorms down the road.
There's a reason why also it's trading that way. Yeah.
Exactly, right? And I'm just pointing out that if you're buying Ayala, any of the subs today, you're actually buying it cheaper than it was from the original investors. That's just what I'm just trying to point out here.
It's parang
And
pampalubog loob.
and the reason why I'm sharing this also is because you have smaller companies also in the portfolio of the Ayala, right? And maybe a billion, which is 5% of the 20 billion that is done on the buyback, can impact share prices tremendously for some of these individual subs. So it's good to watch out for.
Right. So that 20 billion, I think, one of the stocks that we mentioned back then was SM, that they have a buyback also of 60 billion. But I think the difference between Ayala, it's damay lahat ng subsidiaries niya. It's allocated also.
And last but not the least, we have MREIT, right? I call this a little bit more surprising to me because on average, MREIT is supposed to give out around 1 peso in cash dividend. So that translates to around
Yes.
7.2, 7.4% yield in the case of MREIT. And they just placed out more shares at a discount to increase their float. I don't know if it is because they're going to do more asset injection into the company. And that's the
Yeah.
reason why they need to get ahead and raise the float as early as today. Of course, there is some share overhang. Nobody likes it when you're going to be selling shares at a discount.
Discount, yep.
But nonetheless, hopefully things don't change and the yield still remains strong and consistent. I think that's the
Yeah.
key part for buying REITs today. Because let's face it, most of the REITs have gone up because
Yes.
interest rates have gone down. You
Yeah.
can talk about A REIT, C REIT, even some of the laggards like Philinvest have also rallied. So I think the point being here is that why place out when interest rates are falling? Or is it because they're going to do a massive injection? That's the reason why.
Injection, yeah.
I think it still remains to be seen. Hopefully, it's the other way around, meaning it's a positive way where they're going to be injecting more assets into MREIT.
Why do you say, is there a negative side to it? The reason why parang there's a problem kaya ganun?
Well, nobody likes it when insiders sell, right?
Yes, exactly. We tell that then.
Yeah.
So
So
parang it's really a wait and see on what they'll do with that race.
I think we'll probably see more disclosure. And for me, how I look at it, just view it as if it's still yield. So at today's yield, it's still very much attractive.
Ako rin, when I actually saw the chart of MREIT, parang sabi ko, what's happening? Tapos yun pala, they sold shares, and sabi dito, the company will be submitting required reinvestment plan. So I think it's a wait and see. But like what you said, the yield is very attractive at this point, relative and compared to other REITs that's already up there. So I think, diba, you see an opportunity both in capital and dividend play.
Yep, I agree.
So I think we've covered everything for a week. Anything that you're looking forward for the next week, Edmund?
Ay, sana mag-rally ng market.
Oh, at least we're seeing it. The next thing, sana hindi na lang mag-new low. Di ba?
And how we view things is the weaker dollar should lead into more flows for the rest of the world. We know the real winner that's been benefiting from this weaker dollar has been China and Hong Kong. That's the reason why Hong Kong markets are sitting at new highs, right? Pahingi naman kahit konti. Yun na lang.
Yun na lang. Yeah, so that is it again, guys, for our market movers this week. Again, if you've enjoyed or if you want us to cover anything, please comment them down below and we'll see you again next week. Bye, guys, and thank you. God bless.